All right. Hello, everybody. Give me 1 second. Let me put in the right mic. All right. There we go. Mic should be in. Hello, everybody. Welcome back to another Market Open. It is September 25th, 2023. It is 8:55 a.m. I'm a little bit late today because I've had a very, very busy morning, but we are here and we are ready to go. And it's time to open up the markets. Oh man, there is a lot to talk about, a lot of stuff that's going on. Really, the reason I think this week is going to be interesting is because this is the last week of September. Historically, September sucks for the markets, just not as fun as market as people want it to be historically. And so the trend is going to either continue or it's going to change. The trend being September ending out with stocks down for the month. Now, historically, where we are is that when August is down as much as it was, but then recovers at the end of the month, September tends to do well at the end of the month versus bad, because August was bad than good. Usually August is bad, September is bad, October is the rebound, but we are in a little bit of a different cycle this month. So it's going to be really interesting to see how stocks end out. We haven't had a retracement the way we've had since last week in stocks. And either the market says, we want a little bit more. We're not done repricing some of these valuations given Jerome Powell's higher for longer sentiment, or the market's like, we really don't care and we're going to keep going. And the market's going to rebound a little bit. So it'll be interesting to see how this all takes off. Joseph Viegas, Zach Wagner, Pete Hoksung, Ray, question mark, best market open. Thank you for being here. Kane Frost, Sanjay, Socrates, Edmund, Matt, did you see the Tesla bot update clip? I did. We're going to talk about that because that Tesla bot update had a lot of people going crazy on, again, the potential of what the Tesla bot could be for Tesla stock. FR310, good morning. Atit, Tessa Best, Dex. Sanjay was wondering what I was going to do with my life when the live stream didn't start. I'm sorry, had to be a little late, but we are here today. Sethi Roth, Dexter, Marcus Garcia, Doug C, Noodler, David, Mark, Iboff, Matt Blake. Thank you all for being here today. Dario says, Stocks Country, let's cry. Monty, hello. All right, let's see what's going to happen. So first of all, I just want to give an update on some of the positions going on in the market, and then we're going to get to our segments for today. Right now, we've got red in the pre-market, lots of red. We were green in the futures last night, so one would thought then maybe the green would come up a little bit, but we are pretty red. So Robinhood is green. It's up 1 cent in the pre-market. Unity is down. Google's down. Square is down. S&P 500, 429. We're in the 420s is down. Snapchat is down. Snapchat is $8.65 now. This is pretty crazy. SoFi is at 747 in the pre-markets. It's a pretty red base. Enphase is down to about 118. Where's Enphase at? 119.15. Open Doors down. Tesla, my goodness, 241. Tesla's $1.30 being away from the 230s. Why are we down so much in the pre-markets? Well, honestly, it's because the market is tired of what happened last week with the Fed. And, at the end of the day, if you think interest rates are going to be higher for longer, bond yields are going to be giving you a much better return. And so if we look at the 10-year, 2-year right now, 10-year bond is up in the pre-markets. Wow. 10 years at 4.515. Wow. 4.5 is actually pretty decent for the 10-year. We were stuck at 4.43 for a long time. So 10-year at 4.5, which means the 2-year, please don't be 4.6. I mean, it was always going to be more than 5. I forgot about that. 5.123. So that one's a little bit up from last Friday as well. That's why we see stocks suffering. Now, here's what's going to be interesting to see, and then we'll get into some news stories. What's going to be really interesting for me to see, very interesting for me to see, is if the market thinks this is a dip that's reasonable enough to buy, or they just crash us more going into September. Like, for example, SoFi. SoFi at 747, in my opinion, is an absolute steal. Like, that's just ridiculous. If SoFi goes back to the 699 levels, 680 levels, I mean, that's one hell of a, wow. Like, the fact that that's happening. And you got to ask yourself, does the company really deserve at that point to be worth $5.8 billion given all their growth? Or Is this the correct valuation for how the market's pricing it? The answer to that question depends on, do you think the Fed is lying or not? And I think there's a lot of reasons for why this higher for longer narrative, given where inflation is going and how precipitously it's going to come down, is probably nonsense, because the Fed is only concerned about interest rates being higher for longer, because they're afraid of inflation. That's it. If inflation comes down and it comes down aggressively, then the Fed can't have this higher for longer narrative, and eventually something's going to break and they're going to have to cut. The question becomes, does the market believe that? Because if the market believes that, buying SoFi at 747, even with this Fed narrative, makes a lot of sense. If the market doesn't believe that, then that's not going to be something, that the market's going to eat up. So I think that's going to be the interesting to see today. Nvidia as well at 413 pre-market. It's a pretty bloody pre-market. I expect there's going to be a lot of pain as we start the market. But honestly, and this has been my position for a while, I think it's one of those things where you rip off the Band-Aid. We feel the pain up till 420. That would be a true correction. And then, people can start playing in the market because equities will start getting attractive. But if we were at 460 right now in the S&P 500, a lot of money would not be coming in. It's just that simple. Maybe we do need to rip off the Band-Aid, have a 10% correction, get to 410, 420 on the S&P, and then we'll see what happens. So we will see where that goes from there. Farino says, how do you view the prospects of fintech sector in the coming future? We'll talk about that a little bit later, getting into the morning open. I think fintech will be fine. Obviously, fintech has been hammered the past week, and everyone heavy in fintech has held some pretty big bags, including myself, and it sucks. But I think overall, in the long term, fintech is going to be fine. And the rising interest rates narrative is just screwing every stock. Fintech getting screwed a little bit more. There's no reason why when stocks go up, fintech won't come up as well. Let's get into the writer strike. That's the first topic I want to get to today, and then we'll get into a lot more macro stuff. So let's talk about the writer strike. We officially have a deal, and that deal is for the writers union and the Hollywood executives to finally have come together and come to an agreement for what the negotiations will look like. And the reason why this negotiation is really, really important is because Netflix, Disney, Paramount, all of these big, exciting companies are finally going to be able to make content. Netflix is not going to have to throw suits at you to be able to get you to consume. And production is going to be able to be started. If that production is going to be able to be started, it means that they've been able to find use cases around AI that have been interesting, use cases around AI that don't kill people's jobs, and primarily symbiotic ways where humans and AI can work together. And if that's the case and happening in one industry, that's probably going to happen in many more as well. So let's get an update on that right now, and let's see where it's going from here. Also, if we got an update on the Hollywood writers, I would imagine we're probably going to be hopefully getting some UAW updates soon. But that one's a little bit more complex than this one. It's just when one union goes out, it tends to have a cascading effect around other strikes that are going on because people don't want to be waiting for unions to keep going.
Have reached a deal to end the strike. Matt Bellany from Puck joins us now. I've got a lot to talk about. Matt, did you supposedly this was going to be the year the Bears did a little bit better. The reason I'm bringing that up is because Travis Kelce's got a new squeeze, apparently. And I don't know whether you saw that.
Oh, I did.
You did. And he, I get nervous when someone's watching me 24 TV season, right? I mean, this will work if it actually happens, and then you get the actors.
I thought you were talking about the Kelce movie. There's a Kelce movie out now, too.
Is there a Kelce?
Yeah, I just saw it yesterday.
And about 100 commercials. 100
Amazon
commercials.
Prime.
Travis Kelce is in every commercial that comes on now. Sorry, but go ahead.
Yeah, no, this is the Taylor Swift movie we're talking about. And she's an interesting one because, she could promote her movie potentially if she wanted to. That's a big thing in the SAG-AFTRA actors strike is they're not allowed to promote. But that wasn't the deal that was made last night. Last night, the writers in the studios came to a tentative agreement to end that 146-day strike that we've been talking about all summer.
What do you know? Because neither side are allowed to really divulge any of the details, but we can assume that the studios acceded to some of these things, right?
Oh, absolutely. There was definitely compromises on both sides. And from what I'm told, the writers are getting a success metric in streaming, which was a big point of contention. They wanted to see data. They wanted to see how well their shows are.
Wow, I didn't know that. All right, so now just like YouTubers got to see their views, writers can finally get to see, the views from Netflix and Prime.
Doing, and they wanted some of their residuals to be given to them as a bonus if their shows do well. And I'm told that they did get that metric. They also got concessions on AI. The studios did agree to give them pretty broad protections against using their work for AI training. Now, the studios did get the ability to experiment a little bit, and they're going to reframe what their positions are going to be in the next round in 3 years. And they got wage increases and the normal things that you would expect.
And why?
So what'd they give?
Yeah, what did they have to give up? I guess they wanted
Well,
even
for
more.
instance, on this minimum staffing issue where they wanted a certain number of writers to be hired for each show, they didn't get the number that they wanted, I'm told. They did get something, and it's going to be based on the number of episodes per show, and the showrunner is going to be involved in the decision, but they didn't get that. They also wanted, they wanted broader transparency where they would get access to all sorts of data that they're probably not going to get. And there were a couple of other issues like with wages and things that they didn't get. They also wanted the ability to strike if other guilds are on strike, and they're not getting that. But it's definitely more than what they were offered on May 1st, which is when they went on strike.
Why have I read in a couple of different places that this opens the door for a settlement with the actors? Why?
Well, because the thinking is that the actors will use a number of these terms from the writer's deal as a template and then build upon that. The actors have some very specific issues that are specific to actors. They've also asked for wage increases above and beyond what the writers even asked for. So we'll see what they get on that. But
So apparently the actors are on strike, even though the writers have reached an agreement. I didn't know that. I actually did not know that. I did not know actors were striking separately from writers. I thought they were all in the same union. Interesting. Well, I mean, some of those concessions are important because at the end of the day, when you're the Disney Netflix studio executive and your argument is, hey, we need to make more content and keep people on the platform and the actors aren't working. If your biggest concern, like the funny thing about this is the biggest concern to the studio exec is, why should I have to pay you all this money if I can just have AI do a lot of this stuff? Why can't I train your material on AI to make sure that I don't need to, pay dramatically for the future? It's reasonable. However, as you can see, a lot of this stuff is going to be redecided in 3 years. And so if I'm an executive and I need to get content out immediately, I have 3 years before the next bargaining agreement to figure out how AI can be implemented within the platform or within, the overall writing process for shows. So if in 3 years AI becomes like so undeniable, almost like the internet was, right? Where like you can't strike about this. Like this is just part of our life. This is what it is. It's like you're using it, everyone's using it. There's no way to deny it. Maybe there's a better bargaining agreement from the executives because they're going to be like, it's so embedded in our lives that we have to use it. And it would be like not using the internet to post content at one point and only going through linear TV. So I don't know. I mean, this is going to be redecided 3 years from now. I don't think this is over, but it seems like the writers got a lot of what they wanted. The actors will probably get a lot of what they want, but it doesn't mean that this fight is over because eventually AI is going to be more deflationary. A lot of actors can be easily replaced. Yeah. I mean, we spent like a good 10 minutes on Finance Junkies a couple episodes ago showing AI oriented movies and trailers, and like, it's real stuff, man. Like this is real stuff. And I don't want actors to be replaced. I mean, I don't want to watch AI like oriented content. But if it becomes indistinguishable from reality, there's going to be a point where a lot of studio executives can churn out so much content for like 1/5 of the cost. And so I think in 3 years, this saga will be redecided again because it's not going to be as simple as these agreements that the writers union got today. It doesn't seem like that. My PayPal January 2025 calls look like the Denver Broncos D yesterday. Oh my gosh. I didn't watch any football. I do know the Cowboys lost, right? But the Cowboys always lose because they're the Cowboys. Yeah, look, those PayPal 2025 calls, they're looking bad for everybody. I mean, look, I think this week is going to suck again. But if it sucks enough to get us to 420, we will have officially. First of all, I'll be right. That'd be cool. I would have been right. I've been saying we're going to get a 10% correction for a while. But that 10% correction will have happened. And then I don't see it going from 420 on the S&P, NASDAQ probably around 12,500, and then there's being this cataclysmic effect of us now bottoming at a 340 or just ruining all the gains. I just don't see that happening, because at the end of the day, equities are going to be, forget cheap. I mean, they're going to be like, Robinhood might be $7-8. Like, it's going to be like, Meta will probably go back to 210. I mean, things are going to get really and their earnings in Q3 are going to be really good. Earnings are not going to be bad this year. For some companies, yeah, but for most tech companies that had a rally, they're going to be fine. And so if that's the case, I don't know how the market's going to be able to justify some of those prices without taking a nibble. I don't think we're in 2022 where the knife keeps falling and falling and falling. I just don't see. I don't see the macro catalyst to support it. In 2022, what was the macro catalyst? Something kept going up, and that was interest rates. And aggressively, 75 basis points 3 times in a row, then 50, then 50, then 25, then 25. And inflation wouldn't come down until really a couple months ago, where we finally got it at 3%. So I think I just don't see those catalysts to be able to get it to be as bad this week. I feel sports is the only thing that's safe and not impressive. If a robot programmed to do a backflip does a backflip. That is correct. Sports will never be replaced with AI, or will it? No, I don't think it will. But if it does, that's an even crazier world we're living in. All right, we got some new breaking news. Let's move on to this topic. It's 9/11 right now. We're going to be opening the market in about 19 minutes. Amazon is investing in a new company that is rivaling OpenAI. So let's pull up this article here. This one broke this morning, and it's really interesting. I've heard of this company before, but it seems like Amazon is going deeper into them. Anthropic, a rival to ChatGPT developer, Amazon put in $4 billion. This is interesting. E-commerce giant Amazon on Monday said it will invest up to $4 billion in taking minority ownership. The move underscores Amazon's aggressive AI push as it looks to keep pace with Microsoft and Google. The two firms on Monday said they are forming a strategic collaboration to advance generative AI. The startup will obviously use AWS as its primary cloud provider. The interesting thing about these cloud platforms partnering with these kind of, large language model AI startups is that a lot of what is going to be used for AI is ultimately going to help cloud. And this is why the bull case for Amazon, Google, and Microsoft is intact for AI, and they don't even have to do anything with AI. All they have to do is be the cloud service provider for every company using some level of AI, startup-oriented AI backend, because they get paid a lot. It takes a lot of cloud compute to be able to try to do this. Anthropic will use custom AWS designed semiconductors to train the foundational models that underpin its AI applications. Foundational models are large AI programs trained on vast amounts of data. This year, chip firm NVIDIA is the chip firm seeing the biggest gains from the generative AI boom. NVIDIA's key product is a type of semiconductor known as a graphics processing unit, which can be used to train huge AI models. And again, that's why the bull case for NVIDIA's demand is the bull case for software companies' demand, because if their GPUs have a ton of training, essentially progress, training hours on them, that means that is being trained for a lot of software that is using those GPUs, i.e. things like Palantir. Anthropic already counts some high-profile backers, including Google and Salesforce and Ventures. This support comes as tech giants continue to make massive bets on AI companies. Let's actually go to Anthropic's website. I've never been to their website. Anthropic AI. Okay, so here we are. AI research and products that put safety at the frontier. I've never used the company that used Anthropic, but maybe I have and I don't even know. Oh, Claude. Claude is actually huge. Yeah. Claude is used in a lot of different places. Now I know who these guys are. Claude has been doing some amazing things with text to video as well. Claude is pretty interesting. So now what does this mean for Microsoft and Google? I don't think Amazon is going to be the biggest player when it comes to investing in some of these generative AI companies, because Microsoft's obviously developing their own with OpenAI. That's why they own 47% of them. And Google with Bard is getting a lot better. I'm using Bard a little bit more. Bard is also, as a large language model, being trained on so much real-time data. Like if I wanted to ask what's the market cap of Robinhood, it'll actually give me the correct answer. It'll tell me their earnings per share of last quarter, because it's updated, because it's Google. Google has all that data. So in terms of a consumer-facing model, obviously, I think that makes a lot of sense. However, one of the bull cases for a lot of these AI platforms is that the enterprise version of LLMs just might end up being bigger than the consumer use cases in terms of offering overall productivity. The consumer use cases, there's millions of copies of these. There is an app on the App Store called Wingman. I saw it the other day. It's number 25 on the lifestyle charts. Wingman is a GPT powered dating solution. So like you text a screenshot of a conversation you're having with someone and it'll tell you what's the next best thing to say that will give you a shot of getting that person to like you or whatever. And it's really, really interesting. And I saw it on a TikTok ad. So it's just like people are finding ways to wrap GPT and the LLM use cases for very niche consumer use cases, but obviously dating, if we know what's going on with Tinder, there's a massive use case there. So there's a world in which a lot of those consumer use cases are just commoditized to such a degree that the enterprise is actually where a ton of the true monetary value ultimately exists. Kimberly, good morning. Get someone who looks at you the way Amit looks at you in his thumbnail. Just it's those mornings. We can't have the happy thumbnail yet because we're not in the green. Speaking of Tinder, let's cover the subject real quick and then we'll move on to some more macro. Tinder has launched a $500 per month subscription. This is first of all, I think this is genius, to be honest, but it's also just like it makes sense for why they're doing this at the end of the day. So the Tinder subscription will allow, I don't even know what they're going to allow because I didn't pay for this because I'm not paying $500 a month for Tinder. But it is a subscription that will essentially give you a VIP feature. It will not guarantee finding love, but it's going to allow you to access different things. So one of the big things is search. So you get, I guess you can like search for like 5'4" blonde in Miami, and like maybe that's how they're using AI to and that's what you get. If you can't do that and you're paying $500 a month, I don't know what type of search they're providing you. Like they better have some advanced search where you can immediately find an answer. And then they have better matching services for you on this Tinder Plus service. Now, if you wanted to invest in Tinder, you can. Their company is called Match Group, ticker symbol MTCH, I believe. Let's get the right stock. It hasn't done much over the past couple of years. It's been pretty flat. MTCH, yeah. They own I don't know if they own Bumble. I think they own Hinge, they own eHarmony, they own dating.com. They own a lot of these companies. It's just never been something that's super interesting for me to invest in because I've never seen the growth curve around Tinder being like something you want to hype on. The company saw declining subscriber numbers in each of the last 3 quarters, but it has managed to grow average revenue per user on a year-over-year basis. And that's probably why they're doing this, because if they can't get enough subscribers, but they can increase the ARPU on the existing ones, then it makes sense for them. During second quarter results in August, the company beat revenue estimates and raised its third quarter outlook, citing Tinder's growth and revenue acceleration that exceeded internal expectations. Shares are flat this year, obviously compared to the S&P going up by 13%. I think this makes a lot of sense. At the end of the day, people have money. It's just a question of asking them and providing them a decent service to get that money. And so if you say, hey, we are going to give you this higher probability of falling in love and finding somebody, then for $500 a month, that's what, $6,000 a year if it takes you 12 months. It's actually not a bad deal at all. $500 a month. I mean, the amount of money guys are willing to pay. I took a girl on a date once and I spent $500 in a night. I mean, like, I'm not even ashamed to admit, like, I did that, bro. Like, it happens. Like, it happens when you're in the heat of moment. You're like, no, let's get the Uber. No, don't worry. Let's get a couple more drinks. Why not? Like, that's so $500 a month. Yeah, I'd imagine people would do it. Ramu says, who the hell's Ramu? You're married. It's different, bro. You're not. You got your job done. For all the singles out here trying to find love in this AI-driven economy, you know, we're worried about the Roman Empire and stuff. We got to find our love before this Roman Empire collapses. Mateo, 500 in a night is a lot of coffee. Okay, let me do a quick segue and then we're going to move on to the next topic. So I found this girl on Instagram and she's a housewife at 21 years old. I don't know how you're a housewife at 21 years old. You're supposed to be starting your career, but whatever. She doesn't have any kids. And her Instagram reels, I tweeted about this. It just made me like, I fell in love with her Instagram reels, bro. She wakes up in the morning. She makes the food for her husband. He works at like some drill place in Indiana. Yes, I know they're in Indiana because I'm like obsessed with their life. And then she gets her hair done. She goes to Starbucks. She takes a shower. She goes to the gym. She goes to Target. And I'm looking at her day and I just can't stop watching more of her reels. I'm infatuated with her life. And it's not even like it's I don't know. I was trying to figure out, like, do I like her because she looks good? And like, yeah, she's cute. That's fine. But the routine of her day was so interesting to me. Like, and I just started binging all of her. And she has 96,000 followers, so I'm not the only one who felt that way. But that's why Mateo's saying 500 a night is a lot of coffee, because in some of her reels, her boyfriend or husband bought her coffee. So it's but that's why I think people would pay 500 a month, bro. People would pay if I was willing to pay 500 for a date. Like, when you're in the heat of the moment, you're in the heat of the moment, bro. Like, when you're showing off, like, I got her Broadway tickets. Like, I was like, I didn't give a fuck, bro. I was like, we're going all out. Fuck this. And then you look at your bank account, like, did I really spend 500? I did the numbers. I was like, oh, 563. That's $500. That's a lot of money. All right. Let's get into the market. We got 10 minutes until the market opens. Let's open up some of these charts and see what we have going on. Obviously, things are not pretty, like the girl on the Instagram thing. Things are not as pretty as her. 13.13 on Palantir was the closing price on Friday. Right now we're at 13.98, so we're red on Palantir. SoFi 7.42, PayPal 57.53, Instacart 29.80. That one everyone saw coming, but nonetheless it's down. Nasdaq 13,002. That's probably going to open up, I would say, at 13,001 or at least 12,900. S&P at 429. Gut feeling, in my opinion, TFC at 2803 is that we're going to see a pretty big downturn today, just in terms of things are going to be red. And eventually this red is going to lead to the market being like, all right, it's time to get back in. But I don't know if today's the day. Again, the reason why this is happening, Bitcoin at 26,131, is the markets believe that this higher for longer narrative is going to ruin the worst case for stocks. What is the worst case for stocks? Or sorry, the best case for stocks? The best case for stocks is inflation goes down and growth still continues. Meaning inflation comes down, which is amazing. We want inflation to come down, but growth also goes up. So we're not in stagflation. If that happens, Jerome Powell is saying, okay, you got inflation to come down, check. Growth is still going up, which means unemployment is not crazy, check. But we're still not going to lower rates. That is why the market's like, if the Fed's not BSing about that thesis, then like, yeah, we need to reprice equities. Because if the Fed is serious about this idea of higher for longer, and they're, maybe going to cut in 2024, 25, 50 basis points, which is really nothing, then we're in a whole world of trouble, because the cost of capital being that high is just going to mess up a lot of potential growth for these companies. So that is a pretty tough thing for the market to deal with. And that's why we're seeing some of these companies get priced the way they're getting priced. Now, look, at the end of the day, where's Meta? I think a company like Meta, it's at what, 297 in the free markets. You could argue that Meta and a 6 times price to sales is a little expensive. I wouldn't argue that's the case, but you could say that's the case, right? You could definitely make an argument for it. If Meta goes back to like 3 times price to sales, if the market actually prices it that way, there's going to be people buying the dip. And the problem here is in 2022, the valuations didn't make any sense, right? Meta was at $88, whether you like or hate Meta, $88 didn't make sense. But the narrative made sense of rising interest rates. Maybe these stocks got so overvalued in 2021, yada, 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 yada. That's changed. And what do I mean by that's changed? These companies cut the fat. They fired hundreds of thousands of people across all the tech companies. Robinhood was doing layoffs, for goodness sakes. Like, these companies got rid of a lot of the fat, and their operating income increased significantly. And on top of that, their revenue didn't go down the drain. I mean, like, Meta's putting up $32 billion a quarter in terms of, like, they're not messing up when it comes to growth. They're like, growth is phenomenal for these companies. So if growth is still amazing and Q3 earnings continues to show that, and they cut so much of the fat that they just, they don't have 15,000 people doing nothing at the company all day, and they're saving on those costs. If you see Meta contract to like some stupid valuations, it's going to be hard for me to see how stupid they can get. Because in 2022, they could get stupid. Things could get rough. I don't know if they can get that stupid again this time around. I really don't. Because I don't think the narrative is on their side. And I think that's the biggest issue here. Ian says rumor Square is going to do a massive layoff to cut costs. All right, where's Square? Who's owning who? By the way, who has Square? 6 minutes into the market open. Wow, Square's at 44.50 in the pre-markets. This one's tough, man. This one is tough. Fell from 80 to 40. I mean, this one's tough. There was a tweet this weekend that I kind of agree with. The tweet was, Jack Dorsey cares the least about shareholder return. And I don't know. I mean, the way I was looking at that, given Jack Dorsey's history with running Twitter, you can't argue that the guy really loves shareholder returns. He ran Twitter into the ground, absolutely did not give shareholders a return. They pumped during COVID because of interest rates. And after that, they fell back to where they were supposed to be. The only thing that got him shareholder returns was Elon Musk coming in and buying the company. So it's Square and their $1 billion of stock-based compensation. Yes, they have Cash App, and that is the best probably fintech product on the planet in terms of growth. I think it has like $940 million of gross transaction volume within the product. It's amazing. Actually, no, that was actually revenue. The transaction volume is in the billions. The revenue they did last quarter alone off that was $940 million. But I don't know if he's running the company to the point where it's investable. DMNG says he didn't run Twitter. He only founded it. He was pushed out. There's also a lot of controversy. I know the Twitter story. There's a lot of back and forth with him. Ev Williams, he claims that he was an initial founder, even though the stories don't. But yeah, I mean, look, maybe he wasn't the best founder, so that's why he didn't do it the best. Garcia says, out of the top tech stocks, Microsoft has the lowest year return date at 30%, and its 3-month return is 5%. Look, I'm not a big fan of Microsoft, quite frankly. Microsoft's already valued really heavily. Like, I would pick Google over Microsoft just in terms of, it makes sense why Microsoft has the smallest year-to-date return. Google originally had the smallest year-to-date return, and then Microsoft is at 40, Google's at 34, now Google's at 55. I guess Microsoft's a little bit lower than that. Microsoft is a $2.36 trillion company. There's still plenty of alpha in Microsoft. It's just going to take some time to materialize. And so Google seems like the broader bet to me here. Austin Smith says, hey, Amit, how it's going? How are you, Austin? Thank you all for being here. We have 3 minutes until the market opens. We see a lot of red in this pre-market, so we're going to have to deal with it. JP Morgan is red. Bank of America is red. PayPal is red. It was almost like at once on Friday that the market tanked the fintech stocks. I think it was like 11:40 a.m. I looked at my portfolio and things were red, like red. And I was like, oh, wow. And then SoFi was red. Palantir was red. All of these big boys were red. And it seemed pretty obvious that the high frequency trading algorithms were ready to tank the market. That's basically what it seemed like. So we'll see where it goes from here today. 57.88. This is the last week of September. September 25th. We have 6 more days left in this month, and we are going to see where things go. Ian says, is Enphase going to double digits? Man, I don't think it's going to double digits. I think like 105. I think that's the last gap that has to be filled on Enphase if it does keep falling. If Enphase goes below 100, I think that might be an Enphase thing. I don't think that's a market thing. Like if Enphase actually drops below 100, that might be because Enphase sucks, not because the market sucks. I don't know if the market gets that bad where Enphase falls with it below 100. But just be ready, because when you open your portfolios in about 1 minute, 30 seconds, it's not going to be pretty. It's really not going to be nice. I mean, it's going to be a bloodbath just like it was on Friday. We are not getting a break. And you thought last night the futures would have indicated, oh, maybe we're getting a little break. Maybe people are ready to buy the... Nope. People are not ready to buy the dip just yet. It's going to get red. It is going to happen. And it's time to embrace it. There's nothing more we can do about it. Justin says, what's your shopping list look like if the S&P goes to 420? Definitely SoFi would be on that list. PayPal, to me, would be on that list. Palantir probably would be at $12 or like $12.40. That would absolutely be on my list. Palantir would be the first one I buy out of all of those. Robinhood probably would get down to around $8.90. That would be on my list. Google would be on my list. Google probably gets to like 124-ish. 125-ish if PayPal gets that back. Where's Google right now? 131, right? 130 in the pre-market. Yeah, probably 125 if we see that. So there's going to be a lot of stocks on sale. And again, the question is, if we get to 420, 30 seconds since the market open, is there a unique reason, or is it just the market feeling scared about the Fed? Because if there's no fundamental reason for the market to crash that badly, then it's one of those things where you have to be like, this is a great opportunity. But if you think there's like a credit event coming where there's going to be millions of delinquencies in the United States or something, that's a whole different question, right? And so when we see S&P decline that much, we have to really compare to that narrative and then make a decision from there and see what happens. Would you buy Tesla 200? Probably. Tesla gets to 200, 190, 200. I think that wouldn't be the worst price to go into Tesla. All right. September 25th, 2023, 9:30 a.m. Here we go. Last week of September. The market is open. Wake your ass up. All right, let's see how bloody we get into it. Meta, 296, it's red. Bank of America, 27, it's red. JP Morgan, 145, it's red. PayPal, 57.77, it's red. About 20 cents or 30 cents away from its 52-week low. SoFi, 746, down 1%. SoFi is indeed red. Palantir, what do we have? 1394. Palantir is red. Instacart is red. 29.92. Square, 44.52 is red. Microsoft is green, about 0.11%. Enphase is red. Google is red at 130. The indices, let's check out the S&P 500. 429. 429 in the pre-markets. S&P 500 is $429. So we are in the 420s officially for the S&P 500 as the market is open. And let's go to the NASDAQ. I think we're at 13,100. Where are we at? NASDAQ. We are at 13,169. So we're down about 40 points. NASDAQ not taking the worst hit as we open the pre-markets or the regular markets, but still down. NVIDIA, 415. Robinhood, 961. Actually up a little bit from the pre-markets. Key Group, Zion, TFC, all of the regionals are down a little bit. 27.94 for Truist. Zion at 33. Key Group at 10.54. Zoom, $68.32. Roku, $69.25. Kathy is not getting a break on any of those stocks. I would think ARK's probably at 37. ARK's at $38.46. ARK has actually done well this year, up about 30%, but it's up from almost, I think at one point it was below 20. So if you bought it at the beginning of the year, you've done well, but if you bought it in 2021, it's not been that good. Open Door, $2.40. Uber, 44. Uber again had great earnings. They're GAAP profitable, still at $44. Duolingo, 150. Mercado Libre, 1270. They are down from about 1440, so they took a little bit of a hit. Lucid, $4.99. They are officially at a 52-week low. If you've invested in Lucid like the Saudis, well, there you go. You are down to $4.91 on your Lucid. Nikola, $1.02. This was actually running at one point, just like Tupperware was running at one point. Both of these stocks are down pretty significantly right now. Shopify is down. Unity Software on that horrible developer's decision is down. I don't see any green. Where's the green? Confluent. This is a tech company. They're green a little bit. I don't see any other. Roku's a little green at 0.15. Bitcoin, 26,000 is down. Disney's green. That makes sense off the writer's strike that they should be green because that has officially ended this morning. Let's go to Netflix. Did Netflix pump a little bit on that news? Netflix, 382. It's up like they each gained like $1. They're like, all right, we'll get $1 for the biggest part of our supply chain, which are the actors, to finally go back to work. Well, the market will give us $1. Enphase at 120. Enphase a little bit green. Management, who knows? Maybe they're executing more of those buyouts. We'll see in Q3 if there are those buybacks if they did it. But Enphase is a little green. Palantir is red. SoFi is red. PayPal is red. And JP Morgan Meta is also red. Let's go to the other tech stock I want. Oh, Amazon. Where is Amazon? Amazon. Wow. Amazon's at 120. Amazon hit 145 at one point. Amazon right back down to 129. Again, Amazon, their free cash flow is about to explode as they've been cutting costs, but the market is not giving them that premium yet. The market's driving them right back down to 120. Amazon is, outside of Meta, the cheapest, well, not cheapest, but the smallest market cap at 1.3 trillion. Meta being at around 750 billion. Google at 1.72, so that being a little bit higher. Zocold says, I'm loving this. Yeah, I mean, look, there are obviously things that are on sale. Let's see how some other people are reacting to these declines. But this is a red market. It's not as red as I thought it would be. I thought it would be a little bit worse, quite frankly. But it's still pretty red for sure. Good news, stocks go down. Well, that is also something that happens. Let's get an update from Cameron Dawson. She's pretty good analyst, and get her thoughts on where the state of the economy is right now. All right, let's take a look at this.
This morning after a losing week on Wall Street, and joining us right now talking about all of that, what to expect this week, is Cameron Dawson. She is Chief Investment Officer at New Edge Wealth. And Cameron, let's just start with what we've seen in terms of the down market at this point. What are we talking technical support levels?
Yeah, so last week we broke the 4,300 level, which was the August low, and that was an important level to hold. And so now that we broke that, it does put the 200-day moving average in sight for the S&P 500.
She's completely correct on that, and that's why that was a big psychological break as well.
Now, to put it in perspective, that's only 9% from peak to trough, the peak that we got in late July to that 200 days. So that's pretty run-of-the-mill average for a correction. It's bigger for the NASDAQ. The NASDAQ was more overbought. It was more expensive. So it's about 18% down to its 200-day moving average, which is rather bruising. But given the fact that it was up double what the S&P was, it kind of makes sense that it would have a bigger decline.
Yeah, we're still talking about some pretty major gains for the 1 year. You see there for the NASDAQ, it's 21%. I know the S&P is up sharply too, not quite as sharply, but what does this tell you about where we stand, I guess, as we get into October, which is a month that makes people pretty nervous?
Well, I think the thing that's really different about this correction is that it hasn't been growth related. This isn't about growth fears. We can see that by looking at credit spreads. They remain contained. You can also see that by looking at the leadership in the market. You haven't seen a big breakdown in consumer discretionary versus consumer staples, for example. So that would tell us that you're still in that short and shallow category. But if you start to see growth fears start to pick up, that could mean that this period of higher EPS estimates, higher GDP growth estimates could start to be rolling over. So that's where we would look to say that's where you could have a deeper correction. For now, we're not seeing evidence of it yet, but you do have to watch that closely.
The small caps and the industrials have been under some pressure, and that concerns people too.
Yeah, and small caps have sat out the entirety of this rally, really since the October low. That's very different for major market lows. If you look back in 2009, 2020, small caps led because you got Fed support, you got an improving economy. Small caps have done nothing this year and have been a very weak point. That speaks to some lack of risk appetite in the market. Usually when investors are clamoring for risk, they'll pile into small caps, they'll pile into high beta, they'll pile into IPOs, all areas that have been underperforming in the last 2 months.
I guess the good news being it's earnings season, but maybe it's good news, maybe it's not. If you're looking for a catalyst or something else to trade on, we've got to watch that pretty closely too.
And because you've had better economic growth, that does set you up for some upside surprise to earnings. But that's, of course, what we got in the first quarter, what we got in the second quarter. So it will really depend on investor sentiment and how confident they are that those upside surprises can continue. Good to remember, 2024 estimates are still up 12% growth for next year. So that is a fairly high bar, mostly if you think that if we avoided a recession in 2023, does that increase the probability of recession in 24? I think that's the push-pull on the earnings front.
You know, she's right about the push-pull on the earnings front, and it's actually really, it's complicated to figure out because it all depends on one word: the consumer. Like, is the consumer healthy enough? Truly, is the consumer healthy enough to sustain growth in some of these companies? And look, the reason why this is so confusing, the reason why this is so weird is because of iPhone demand. Like the iPhone 15 launch that happened on Friday, there were lines out the store for like miles in some parts of the world. There were people vlogging how long they had to stay. Like the demand was insane. And it's not just that it's about the iPhone that's significant. It's that the fact that people have the money to say they're going to stay, wait in line and go to spend their money. It means that there was excitement from consumers. In a real recession, you don't get excitement from consumers to buy an iPhone, right? People just don't upgrade. They're like, yeah, we're just not going to do it. So that right there, it's already, and then, you know, if people buy an iPhone, they're going to buy cases, they're going to buy products and services. Like it's going to have a cascading effect. The question becomes, is the consumer sustainable enough to give 2024 a meaningful recession? The pushback against that argument I just gave for iPhones is like, look at student loans. If student loans are coming back and people have to pay those, much less people go delinquent. Well, you can't go delinquent on your student loans, but you know what I mean, right? They stop paying back some of their loans. Credit delinquencies are rising. There was a Washington Post article about how they're the largest since 2007. It's not exactly the best analysis, given if you look at the actual charts and the total amount of, you know, things available to even report for that reporting, which is actually puts the level at like 0, quite frankly. So there's a lot of manipulation of these credit event things, and I'm going to try to pull them up and show you guys, but they are going up. We are seeing delinquencies rise, even if the charts are a little bit manipulated in terms of how the data is showcasing them. It's not a apples to apples 2008 comparison because the denominators are different, but it definitely is going up. And if that has some type of cascading effect, the consumer is going to be screwed, right? So I don't know. S&P at 429. It's really hard to gauge because if you believe the consumer is in a horrible situation, you sell, right? You're like, all right, this market's going down. If you believe the consumer is resilient, then you're kind of like, why would I sell, right? Why would I not buy? And then you got a 10-year or 2-year giving you 5%. There's so many more catalysts for the downside versus the upside, but that's usually when the contrarian thing tends to happen and the upside prevails, which is what 2023 was an example for. The question is if that continues. Palantir at 1407. Look at that nice rebound. So we went from 1398 to 1408 for Palantir. SoFi at 757, rebounding a little bit down from 749. And so, this is where you ask yourself the question, right? Like SoFi at 747, it's up 10 cents. It might go back down 10 cents, but what is that floor for SoFi? Does it really go down to the 702, 701, 699s? Or at this level, do buyers step in and they're like, holy crap, I'm getting into this company right now, like they did back in May of 2023. At these prices, people were clamoring to buy SoFi. And, then it ran up all the way to $11.45. NASDAQ at 13,190. Netflix is up. Amazon at 130, a little bit green. S&P still red, 429. Google at 130. And Enphase at 121, up 1.2 cents percent on the day. Nike, Zocolt says he's looking at. Let's look at Nike. Nike right now is at $90. Does Nike pay a dividend? They pay a small dividend, 1.5%. Nike for 1 year, or Nike year to date. Nike has been kind of flat, if not down. Nike has not been in the best situation. Let's actually, here we go. Here's a better look at it. So Nike at the beginning of this year was $120, roundabout 115. Now it's down to 90. So Nike, consumer staple, definitely has not had the best year. It's not part of those companies that continue with the rally. Tech obviously did a lot better. Nike now at $90. I haven't gone through their financials. I would have to go through it. But do consumers stop buying Nike in a recession? That's also a question, right? My answer is yes. I don't ever buy this name brand shit, bro. I'll get my sweatshirts off Amazon for like $10. Like that's, but I'm a different type of guy. Do you believe consumers are just get fed up with this stuff and they just don't go into it? I think these are the questions that are important to try to come to these broader conclusions about the state of the economy. Because if consumers aren't buying Nike, Nike's not advertising as much on Facebook. If Nike's not advertising on Facebook that much, Facebook's earnings are not going to benefit. Like there's all this stuff that happens as a result of that. On top of that, the other problem we have going on is that we have a potential, let's talk about this because we haven't talked about this all morning, government shutdown going on. In the United States, Republicans on Friday failed to pass another piece of legislation that would avoid a shutdown, and they continued to go ahead and let this shutdown process continue in the United States. Right now, we have not had a negotiation yet. People are still trying to find a negotiation. This would be the longest government shutdown in history. Let me actually show this because this is a really interesting chart. Was actually not too far ago. So 1977, we had 3 days shutdown lasting 28 days. Okay. And then in 2011, 2013, this is when Obama was president, we had another pretty bad shutdown. And then 2018, we had 2 shutdowns lasting 36 days. This is when I think, do you guys remember when Trump and Pelosi met in the Oval Office and they had that crazy interview? Not interview, like, I don't know, they were just talking and the media got them and Trump was yelling at her about we need border control. And she was yelling, like, that was in 2018 around this time. It was pretty tough. Right now, I don't know what would be the reason to shut the government down outside of incompetence. There's no thing that Biden wants that's so bad, like stimulus or anything like that, or the Republicans want. This is just stupidity that's going on in the U.S. economy. And that's what would be causing some of those issues. But I don't know exactly, how bad it would end up getting for them to be shut down. They shut it down for $5 billion. Yeah, it's it's pretty ridiculous. When the government is shut down and people still don't realize they don't need the government. Well, the problem is there's a lot of governmental employees, right? And a lot of those government employees don't get paid when the government's shut down. I mean, from the chef to the janitor to congressmen. Like it becomes a tough situation, and eventually they'll find a solution. What it means for us as investors is we have to continuously feel in another state of anxiety when it comes to the capital markets, because it's hard for hedge funds and institutional investors to allocate a crap ton of capital to American companies when the American government isn't operating. It's hard to manage that stuff. And so that's why the government shutdown ultimately affects us. They're shutting down this time is because our budget went up 40% during COVID and it's still elevated. Something needs to change. And this is the Republican argument. The Republican argument is like, guys, we are spending a lot of money, more money than we can imagine. Interest rates are still at above 5%. And so guess what? We have to pay interest on all that money that we are spending. That's a lot. That's a pretty tough predicament that we're in right now. And so as a result of that, we have to be able to reconcile that. And we have to be able to somehow stop it. Now, granted, I don't know if it's coming to an end given where government spend is, but I don't know. It's one of those things where I have no idea how we solve the spending problem. I really don't. Also, Ukraine. That's another thing that happened. We sent $325 million to Ukraine on Friday. Alex Karp talked about that in an interview as well. So there's just so much spending on so many different angles. Like the question ultimately becomes, when does it stop? And if it has a chance to actually stop in the broader scheme of where things are going. We have a new note on Palantir. Shout out to Andrew. Thank you for texting me this. This guy's the GOAT. Every time we have a new note, he texts me this. I get to break it for you guys live. So Bank of America just put out something new on Palantir. Let's pull it up real quick. They still have their $18 price target. Let's take a look on that right now. So this is their takeaway from the Software for Government summit that Palantir hosted. The reason Alex Karp did 2 interviews on Friday is because they are hosting their inaugural summit for the government. So Bank of America just put this out. Let's just read a little bit of it. Mariana is the research analyst from here. Last week, we attended Palantir's first Software for Government Summit in Washington with 300 attendants across the public and private sectors. The event served as a symbolic kickoff of Palantir's new defense platform, Palantir Government Web Services. That makes sense. PGWS, we covered this on the channel. I did a video about this. Just YouTube it, and you'll find me talking about it. Now it makes sense why they actually did a whole summit about this. We walked away from the meeting encouraged about Palantir's opportunity as an enabler to the growing DoD modernization requirements. We maintain our buy rating. Okay, interesting. So it's a very small report, nothing too crazy. 2-page report. I'll do a broader. Oh no, this is a longer report. This is about 4 pages. I'll do a broader video on it, and we'll go a little bit more deeper in it. But let's get let's get an update here of what they talk about PWDS. We see it as the summit as unofficially celebratory launch of Palantir Government Web Services. In a recent company blog posting, Palantir stated that it sees this as akin to a hyperscaler for customers seeking to break into the government contracting world. Okay, so then they talk about some of the things that they can use it for. This makes sense. Defense is one of the strongest adopters of AI tech so far. According to tech industry participants, defense users have become some of the strongest adopters of AI technology. We've seen this with the venture capital spending equating to billions and billions of dollars from the VC space to defense tech startups. One company even admitted that defense users have inadvertently become the largest share of its consumer base. Unlike AI usage in other industries, AI use in the defense applications is actually mission critical and is actively being incorporated into core missions. While healthcare tech and insurance tech have been discussed integrating AI, these consumers generally tend to pivot too frequently between use cases, not offering enough time to build and refine viable databases and models. Getting to that level requires heavy data pools that are constantly growing and need to be labeled and don't take the time to collect the data and refine models to the point of efficacy. Interesting. So Bank of America seems pretty bullish on defense tech being an adopter of the larger AI ecosystem that we're seeing. And Palantir wants to capitalize on that. I'm pretty bullish on Palantir's ability to capitalize on the government space because, again, they're getting a lot of contracts that are sole sourced, and there's just not that many competitors that are innovating as quickly in the AI space for government. Even if there's competitors in the governmental space, not that many that are doing what they're doing when it comes to AI, building out ontology SDKs, things of that nature. So that's really interesting. One of the things that's also important to recognize is this week we are getting an interview with Kathy Wood from Arc Innovation and Shyam Sankar. They're going to be doing an entire podcast on AI. Kathy obviously bought 1 million shares last Friday. That is coming out on September 28th, which is 3 days from now. And that's the reported day we're supposed to get the NHS deal. So if those things go into if those things actually happen and we get the NHS deal the day we get an interview with Kathy and Sham Sanker, that's going to be a hell of a day. But not sure if we're actually going to get that NHS deal that day or if we even get the NHS deal. So we will see if it happens. Serge says, keep in mind, countries owe us almost as much as we owe. It's weird that you can owe money and be owed at the same time. Yeah, that's actually something I have to look at as well, because our debt to GDP ratio is approaching about 140%. Obviously, other countries owe us money as well, right? And they're using the dollar as the reserve currency to back their investments or back their debt, which is why the dollar continues to stay elevated, which is the overall argument that U.S. debt doesn't really matter that much because the dollar is the supreme currency. And until that goes away, we can keep piling up the bill, which, look, I mean, there is logic to that. The problem is, what if the currency, what if India stops trading with the dollar? What if Brazil says we don't care about the dollar anymore? And if that happens, and Russia's currency or China's currency becomes the de facto currency, or in general, the U.S. currency just doesn't get as strong anymore, that's going to have ramifications throughout the ecosystem, especially when it comes to debt and the financing of debt. Like, if people don't like your debt, if Bank of Japan that owns most U.S. debt doesn't want to own our debt anymore, that debt's going to collapse overnight. And that's not going to be a good idea for the U.S. economy. Does Kathy have anything specific about AI you're hoping to hear her discuss? I want to know what she thinks about AI implemented into the enterprise, specifically around large language models. And I know Sham Sanker is going to speak a lot about that, but I want to hear Kathy's perspective because I haven't heard her talk about LLMs as much as I've heard her talk about generic, elements of AI. And she even said that she walked away from that podcast feeling a lot more knowledgeable of what's going around in AI. So I would like to see where she thinks the enterprise spend is going to go, how big she thinks it can get, and the use cases of LLMs. S&P back to 430. Got a nice little rebound. So we're up from 420. S&P right now at 430. Let's see some of these stocks. SoFi 759, officially green. Palantir 1408. Back up from 1398. Robinhood 969. That's a nice little rebound from 946. Regional banking index is up a little bit. Truist is up at 2807. It was at 27 at one point. It's up 0.05%. QQQ making a nice little rebound at 357. Bitcoin is down just a little bit, 0.5%. Apple is down at 174. Disney is up 81.55. So we're seeing a little bit of the dip being bought. It's very little. It could come back down. NASDAQ is officially green on the day, even if it's by 3 points, up 0.03%. Enphase at 122, up 2.4%. And this now becomes the push and pull, right? Does that, Enphase hit 118, now it's back at 122. Did enough investors pile in at 118 where they were like, this is ridiculous, we're buying Enphase? Or is this a little bit, essentially fake and it's going to fall back down to 118 and below? This is the push and pull we're going to have, I think, over the next couple of weeks, especially as we end out October, waiting for the next CPI report to see where the market is going to go and to see where the market ultimately wants to go. Small caps are moving. That is correct. The U.S. debt is too crazy. The Fed rate is going to F up the U.S. debt for a long time. We are paying $2 billion a day right now in interest on our debt. It's kind of crazy. But at the end of the day, if these companies get undervalued, like, yes, a treasury bill can give you 5%. If Google's giving you 40% or 30%, that treasury bill just doesn't look as attractive. And if the risk for Google doesn't seem as high, if the overall economy the narrative starts to make more sense, a lot of these equities become very attractive. And so we'll see. I mean, we will see where the market takes it to end out September and where these things inevitably have to go. All right. That's it for me today. Let's do the final thing we have to do, which is the word of the day, so that we always have something to speak about intelligently as we get into our day-to-day lives. Here we go. Word of the day today: modicum.
Modicum.
A moderate or small amount. Modicum. I would say if you are buying the dip today, it should be in modicum. If that's the right way to use it, it should be a modicum of dip. It should not be a crazy buy the dip because we might see a lot more downside if negative catalysts keep stacking up. But, I don't think buying the dip today is a horrible idea. And I'll see if I end up buying some shares, probably of either SoFi or Palantir a little bit later today. Modicum of salt for my steak. Get a modicum of self-respect to me. Commit. How are you spending $500 on a girl? Get modicum of self-respect. All right. That's it for me, everybody. Thank you all for being here. That's it. We'll see where the market ends up going. I'll see you guys on Finance Junkies today. Have a couple more Palantir videos coming up. and we'll talk markets and see if this dip gets bought up or if it keeps on going down. That's it. Thank you, everybody. I will see you later today, and we'll see you again tomorrow on the Market Open. Have a good one. Bye-bye.